It's late 2019 and everything seems normal. The markets are steady, and most people are optimistic. But take a closer look at the stock charts, and you'll see something unusual. Prices are quietly slipping, breaking key support levels. Those who know how to read these patterns sense trouble brewing months before the world even hears about a pandemic. That's the power of technical analysis. It's not magic, but it feels like it when you see how much the charts reveal. Today, we're going to explore why technical analysis might be the ultimate tool for retail investors, especially if you're just starting out. Now, let's be real. If you've ever tried to understand investing, you've probably heard of fundamental analysis. It's all about looking at the details: earnings, debt, company management, and even macroeconomic factors like inflation and global politics. Fundamentally, these are the forces that move the markets. But here's the catch. How practical is it for you as a retail investor to gather and analyze all this data? Do you have hours to spare dissecting company reports or the resources to get insider-level insights? Most of us don't. Fundamental analysis is like solving a massive jigsaw puzzle, where some pieces are missing and others are hidden behind locked doors. It's undeniably important, but let's face it, it's out of reach for most retail investors. This is where technical analysis comes to the rescue. Instead of trying to gather every piece of data, technical analysis focuses on the price chart, a visual representation of everything happening in the market. Every big event, every small sentiment shift, and even insider moves leave their footprints on the charts. If you learn to read these footprints, you can make smarter decisions without needing a degree in finance. Let me give you some real-world examples to show you how powerful this approach can be. First, let's talk about the COVID crash. In late 2019, well before the world started worrying about a pandemic, the stock charts were already sending warnings. Major indices like the S&P 500 were breaking key support levels, hinting that something big was coming. If you were watching the charts, you'd have seen the signs early and could have protected your investments, or even profited from the downturn. Next, let's look at the 9/11 attacks. Of course, no one could have predicted the tragic events themselves. But the stock charts in the days leading up to 9/11 showed unusual activity, an unexplained downturn, and increased volatility. It's as if the market sensed that something disruptive was about to happen, even though the specifics were unknown. And who could forget the 2008 financial crisis? Long before the housing market collapsed and Lehman Brothers declared bankruptcy, the charts were flashing red flags. Patterns like the head and shoulders formation and consistent declines in key sectors warned of an impending crash. Those who understood these patterns had months to prepare, while others were caught off guard. Do you see the common thread here? The charts don't predict events, but they reveal the collective actions of millions of market participants. And among those participants are people and institutions with access to information that most of us don't have. When you learn to read the charts, you're essentially tapping into the collective wisdom, and sometimes the secrets, of the entire market. Now, let's make this practical. Have you ever looked at a price chart and thought it seemed random, like a jumble of ups and downs? It's not random. Those movements are a reflection of human behavior. Fear, greed, and decision-making at scale. Once you learn the basics of technical analysis, you'll start to see patterns that repeat themselves over and over again. For example, you'll notice trend lines. These are straight lines that connect the highs or lows of a stock price over time. They help you understand the overall direction of the market, whether it's going up, down, or sideways. Knowing the trend alone can give you an edge, because it's often smarter to trade with the trend rather than against it. You'll also come across support and resistance levels. These are price points where the market tends to pause or reverse. Think of support as the floor holding the price up and resistance as the ceiling keeping it down. When a stock breaks through these levels, it often signals a significant move, either up or down. And then there are chart patterns like triangles, flags, and head and shoulders formations. These patterns don't just look cool, they're signals that often precede major price moves. For example, a bull flag might indicate that a stock is gearing up for another upward push, while a head and shoulders pattern might warn of a downturn. Here's the best part. You don't need expensive tools or insider access to start using technical analysis. There are plenty of free charting platforms online that let you draw trend lines, identify patterns, and add simple indicators like moving averages. All you need is a willingness to learn and a bit of practice. And if you're wondering, why should I focus on technical analysis when fundamentals are what truly move the market? The answer is accessibility. As a retail investor, you don't have the same tools, time, or resources as big institutions. But with technical analysis, you can see what they're doing and respond accordingly. It's like having a window into the actions of the smartest money in the market. Let's wrap this up. While fundamental analysis is undeniably important in the grand scheme of things, it's not always practical for retail investors. Technical analysis, on the other hand, gives you a powerful, accessible tool to understand market trends, spot opportunities, and protect yourself from risks. The charts don't lie. They know everything that's happening in the market. You just need to learn how to read them. So are you ready to take control of your investing journey? Hit that subscribe button, leave a comment, and let's start mastering the market together. Your journey into technical analysis begins today.